Hello, everyone, and welcome. My name is Kurt LaLomia, and I will be your presenter today. We're going to get started in just a moment. Let me begin by sharing my screen. I want to welcome you all and thank you. Appreciate you carving out a little time to learn more about Social Security. We're going to review what you need to know, what's important. Again, my name is Kurt. I'll be teaching today's master class. Look, when your parents retired, they probably didn't think too much about Social Security. They just went down to the local office when they turned 65, or maybe it was 62, had they retired early. They applied for their benefits. They took their benefits for granted, didn't ask questions. Obviously, it's different today, and that's why you're here. I want to share a little bit about me and about my firm before we get started. I'm a financial advisor with a company called Turning Point Financial. I've worked in financial services for more than 30 years now. My niche or specialty is with federal employees. Our firm knows the federal benefits really well. Appreciate my existing clients that are tuning in, as well as those of you that have attended before. We've been doing these financial literacy webinars for about 5 years now. I work with folks from most of the federal agencies across the entire country. My company, Turning Point Financial, is a registered investment advisor. We're supervised and regulated by the SEC. We're a team of about 25. We're independent, we're female owned, and our home office is located in Frederick, Maryland. Happy to share a copy of the slide deck if you would like. All you have to do is email me and I'll send that to you. My email address will be up a little later in the presentation. Our website, tpfinancial.com, is listed on this slide. You can learn more about the team, our capabilities, and me on the website. Tell me it doesn't hurt a little bit to read this. This is the main challenge we'll try to solve. But before I do, I want to address a couple things about the presentation. Maybe you're wondering why a financial planner is here to talk about a government program like Social Security. There's really three reasons. One is there's a big need for Social Security education. Two, many uninformed people are making damaging decisions about when and how to claim their Social Security benefits. And those poor decisions, they oftentimes make my job more difficult when I have to help clients develop a retirement income plan to correct for a mistake that was made with Social Security. Two promises. One, I'm trying to make people smarter about claiming their Social Security, and I believe you'll be better prepared to make a good decision after today's presentation. Two, I want to assure you, I'm not here to sell you anything. This is purely an educational event. If you have questions, you can follow up with me by email. Again, my email address will be up at the end. Our next slide, it sort of speaks for itself. I just want to add one more thing. Social Security is just one piece of your overall retirement income strategy. The other pieces, they're going to include your pension, your TSP, what your spouse or partner has going on, and possibly other things. Your bigger picture is obviously a bigger deal. First, there's a few things to know about Social Security, and you can read this. Let me get it all up. My favorite one is the last one, and that's where a lot of folks, they get hung up. Some of your friends and family, they've probably been helped by their Social Security benefits, but at the same time, few of them are likely experts. Moving along, we've all been told for years the system's going broke, but now that it's almost our turn to collect, is that really true? You also want to know how much you can expect to receive. Before you can retire, you've got to know how you're going to support yourself. That means doing a budget, lining up all your income sources, knowing how much you can expect to receive from each of those. Social Security, because it's a relatively known quantity, it represents the foundation of that plan. I think we all know that applying early, the benefit is lower than applying later, but is it worth missing out on all those extra checks to have a higher benefit later? We're going to shed some light on that important question today. Something your parents never asked is, how is it possible to maximize benefits? There's absolutely nothing wrong with using the rules to your advantage. Today, we're going to talk about ways you can maximize your benefits simply by knowing these rules and making smart decisions. The last one there, I think we all know the answer to that. And I'll wrap with coordinating Social Security with the rest of your retirement income. That's going to allow you to pursue a comfortable, worry-free retirement. That's what I spend a lot of time on with my clients. Social Security is far more valuable than people realize, and we're going to show you that. As we said earlier, many folks are worried that it's not going to be around when they retire, and that's led to a lot of misunderstandings and irrational fears about the solvency of the system. Let's look now at what the trustees are saying. Every year they publish a comprehensive report showing the long-range outlook for Social Security. The system was designed as a pay-as-you-go system. Payroll taxes from us and from our employers, they go into a trust fund every pay period, and then that money is immediately paid out to the current retirees. Because folks have been in their peak earning years, the trust fund, it's accumulated more than it needs for the current benefits. Right now, it holds nearly $3 trillion, and that money is invested in special issue Treasury securities. Over the next 75 years, costs will begin to exceed income. There are enough reserves for the system to pay out 100% of promised benefits over the next 10 years. After that, if nothing's done to reform the system, the income will be sufficient to cover just 85% of the benefits. This is not new news, and our politicians, they've faced this before. Here we have the tools at our politicians' disposal, and all of these have been used before back in 1983. I'm 60 years old. I expect to live to age 90. I also expect to collect 100% of my benefits. The precedent has been set, and what you see here is the solution to preserving the longevity of our system. The bottom line for almost all of us is that our benefits are not likely to be affected by much, if at all, and that means we can stop worrying that it won't be there in the future. Here's a straightforward definition. And even after your death, your benefit could continue in the form of survivor benefits, as we'll see. If you've ever looked at your paycheck, or if you haven't in a while, it might be a good idea, because listed on there, the Social Security tax is called FICA, F-I-C-A. That stands for Federal Insurance Contribution Act. You and me and our employers, we paid the premium in every paycheck. So we want to be smart about how and when we collect this earned benefit. Social Security is one of the few sources of income that you can't outlive. If you're worried about running out of personal assets in your old age, you need not have that fear with Social Security because it continues until you die. If your benefit starts out at $2,000 a month and you live 10 more years, you're going to receive almost $300,000. 20 years, $600,000. 30 years, about $1 million. And this all assumes cost of living adjustments of about 2% a year. This is the math, folks, and this slide helps us all quantify the real value of our Social Security. There's inflation adjustments. If your benefit starts out at $2,000 a month and you get 2% a year of COLA, in 10 years, your 2,000 becomes 2,438. You can see what happens in the other years as well. There's no way of knowing exactly what the future COLA will be, but 2% is a reasonable estimate in our opinion. This slide here, I'll just let you read this. That really speaks for itself. We're going to get in the weeds a little bit here. The formula for calculating Social Security, it's a little complex. We're not really going to spend our time here with this slide or the next slide. The AIME you see there, that stands for Average Indexed Monthly Earnings. And the PIA, for Primary Insurance Amount. That's your monthly benefit. Let's move on. This is an example. This is an example of how the benefit formula would work for an individual born in 1963. They earn the Social Security maximum starting at age 22. Highly unlikely, highly unusual, but this is our example. Their average monthly indexed earnings would be $13,689, a lot of money. So if that's your average monthly income, you end up with a little over $4,000 a month as a Social Security benefit. I told you it was complicated. Fortunately, we all don't have to figure this out for ourselves. Our circumstances are unique, and our claiming age is never a straightforward answer. Most people are brainwashed. They think 70 is the right answer. We've talked about that in prior webinars. Your health, your spouse, your plans, your other assets, and the types of accounts you have, those are just a few of the things we talk with our clients about when we're helping them determine their best Social Security claiming strategy. What's missing here from this slide? If you need the money. If you need the money, then it's a no-brainer of a decision and you begin to collect. All these other things here, they matter and they're important. The taxes, the Medicare premiums, and the penalty if you continue to work. The decision of when to apply for benefits is one of the most important and most complicated. It can literally make a difference of many thousands of dollars over your lifetime. It's also important to realize that this decision of when to apply, it depends on so many factors that are unique to you. These include what you see on the slide, and this is why it's not a simple answer. The last part about survivor needs, which we get to in a minute, also factors into our next question. No surprise there. Moving along. Full retirement age, that's the age at which you can claim unreduced benefits. It used to be 65. 1983, the politicians, they bumped it up to 67. Some folks 66, but here's what that looks at. That's the full retirement age. That'll be going up in another 8 or 9 years when our politicians get around to making some adjustments to the system. And I say 8 or 9 years because they'll wait to the last minute, like they did in the last go around. It's politically unpopular to address it now. We've got about 10 years of solvency. They'll wait until something has to be done. Applying early, it simply means your full retirement age is discounted or adjusted. This slide shows those discounts. These amounts, they're prorated monthly. You can apply anytime after age 62. Your benefits reduced by an appropriate amount. Again, let me be clear, there's nothing wrong with claiming early, and we often recommend it to our clients based on their situation. On the other hand, if you wait until after full retirement age, you earn a delayed credit of 8% each year that you delay. All of that is nicely shown here on this slide. This one speaks for itself. I think we all know how to get our statements, get the information online. In addition to the sites here, I always point people simply to ssa.gov. The obvious advantage of delaying benefits is the higher monthly benefit. A person who has a primary insurance amount, that's that PIA, of $3,000 and a full retirement age of 67, they're going to receive $2,100. And that's every month if they applied at 62. And you can see what the other numbers are. I just want to point out something interesting here. I sort of uncovered and realized as I was preparing for this, if you can follow my pointer, age 62, $2,100. If you wait, let's say you wait until 70 and you let the COLA work its magic, we're over here on the far right, this number here, 4359, it's almost double the 2100. That's pretty impressive. Just sort of a point of observation. We're going to move on. Obviously, it can be hard to pass up Social Security checks when you can start receiving them as early as age 62. But if you live a long time, you're going to be glad you waited. As you can see, the longer you live, the more income you'll have, certainly by waiting until age 70 to apply. Let me just say that health and family longevity are a factor, as well as the crossover point or break-even point, which is around age 83. Think about your circumstances, your family longevity, your health, your lifestyle. Are you going to make it to 83 or are you going to make it well beyond 83? That'll help you with your decision making. So we're going to get into some strategies. First thing you can do while we still have time, we want to improve our earnings record. Check your statement, make sure it's accurate. Mistakes are rare, but they can happen, especially for folks self-employed. Next thing to consider is how we might improve that earnings record. As we showed earlier, part of the formula is 35 years of earnings. If you haven't worked 35 years, you got some zeros in there. Continuing to work will fill out those zeros and eliminate those. Even if you start receiving Social Security and continue to work, your earnings record will be updated. However, it's important to know that if you start receiving Social Security before full retirement age, and if you earn over a threshold dollar amount, that's $23,400, there's a penalty, and the penalty is $1 for every two you earn is withheld. Talk about that some more. Applying for benefits. Applying for benefits at the optimal time is the best way to maximize your benefits. Chief reason for delaying is going to be the result of the highest lifetime benefit for you and your survivor. Very important, and your survivor. There's no one-size-fits-all answer to this question. The important thing is to apply at the time that's best for you, and this speaks to what your neighbor or your coworker does. It's good for them, but it might not necessarily be good for you. Let's look at maximizing benefits and minimizing taxes. One important consideration in deciding when to apply is whether or not you plan to work. If you apply before full retirement age, as we said, in 2025, $1 benefits will be withheld for every $2 you earn over $23,400. And while this earnings test isn't truly a tax, it's a way in which the federal government takes back some of your income. That's different from true taxation, which we get to next. This table here shows the taxation of your benefits based on various income levels. Social Security likes to use the term provisional income. That includes your AGI, half of Social Security, and tax-exempt interest. What the heck is all that? Well, they consider all of your sources of income, and that's going to be half of your Social Security, your pension, your required minimum distributions, any part-time income, rental income, and municipal bond interest. Add all those up, that's your provisional income. apply that to this chart, see where you fit. The important thing to remember here, up to 85% of your benefits may be subject to tax, depending upon how much other income you have. So how do we minimize those taxes? Well, there's a number of ways. You lower your other income, especially investment income. We've talked about tax efficient investing in prior webinars. You need to be aware that muni bond interest, it's tax free, but it does count as income for purposes of calculating the tax on these benefits. Talk with your financial advisor about that if you own municipal bonds. Next, anticipate that your RMDs may cause you to be in a higher tax bracket and may cause some of your Social Security benefits to become taxable. You might consider drawing down your IRA before RMD age 73 or doing some Roth conversions along the way. Again, your financial advisor can help you with this. Some like to say delaying claiming Social Security will reduce the number of years your benefits are subject to tax. That's true. However, higher benefits later likely mean more taxes too. So what's the solution? The solution is that last bullet point that I just put up. And we've talked about that in prior webinars too, if you've attended. As I've said so many times before, it's not what you make, but what you keep that matters. And hopefully your financial advisor is talking to you about tax planning. Next, Medicare. Remember, if you're 65 or older and enrolled in Medicare, your Part B premiums, they're going to be deducted from your Social Security check. As you can see here, claiming early, your Part B premium is going to eat up a larger percentage of your benefit than had you waited. You should all know, if you don't already, that the Medicare premiums, they're based on your income, and those monthly premiums currently range from 185 on the low end, which we show on the slide, all the way up to $750 a month on the high end, and those change every year. The when to apply question. It's complex. It requires a customized analysis. Here's a few points to ponder. Delaying benefits, that may give the surviving spouse more income. That's an important point to consider, especially if you're thinking something like this. And our answer is on the next slide. For couples, you should always maximize the higher earner's benefit to protect the surviving spouse, who will step into that benefit after the higher earner dies. Higher earning spouses are often encouraged to delay benefits to age 70. That's because it will give their spouses the highest benefit after they die. Let's take a look at how these spousal benefits work. We have John and Jane. Spousal benefit is 50% of a worker's primary insurance amount. That's their benefit if they apply at full retirement age. So if John's at 2,000 and Jane's PIA is 800, if Jane applies for Social Security at her full retirement age, her benefit is 50% of John's, or $1,000. That's $200 or 20% more than her benefit based on her own work record. Pretty significant. Here are the basic rules for spousal benefits. Primary worker must have filed for benefits. The lower earning spouse must be at least 62 for a reduced amount or full retirement age for the whole thing. Spousal benefits do not earn the delayed credits after full retirement age. Very, very important. The goal is to maximize income for both of you while you're alive and maximize income for the survivor when one of you passes. It can be complicated, but by understanding all the considerations and making some calculations, it is possible. It is possible for married couples to come up with the right solution for their needs. We're going to look at some strategies here. The first thing to look at when you're coordinating your spousal benefits is this. Is the lower earning spouse's PIA more or less than the higher earning spouse's PIA? Don't be confused, folks. PIA is simply the monthly benefit amount. That's on your statements. If the lower earning spouse's benefit is more than 50% of the higher earning spouse's benefit, the way to maximize benefits is for both of you to claim at age 70. That's a black and white answer. It ignores all the other considerations, which I hate, but this is one way to look at it. So this will maximize the benefits over both of your lifetimes if you do that. Let's look at another one. Here, the lower earning spouse's PIA is less than 50%. So you might want to have a look at the hybrid strategy. That's what we show here. The lower earning spouse claims early. This gets income started. This is what I talked about earlier, claiming earlier. And there's nothing wrong with that. This gets the income started as soon as the lower earning spouse turns 62 or whenever they stop working. Higher earning spouse still claims at 70. They maximize that higher benefit over both lifetimes. Hope that helps. All right, moving on to a whole nother category. If you're widowed or divorced, you may be eligible for survivor benefits, divorced spouse survivor benefits, or divorced spouse benefits. By coordinating these benefits with your own record, you may be able to increase your total benefits. Let's look at the basic survivor benefit a spouse would receive. These can be a little complicated. It's important to understand how they work because decisions made now can influence the amount the survivor receives later. Two factors that influence the amount of the survivor benefit. First factor is the age at which the deceased spouse claimed his own retirement benefit. If he or she originally applied for Social Security before full retirement age, then the survivor benefit is discounted. It's 82.5%. If applied for at full retirement age, you get the full 100%. Our next factor second factor influencing the amount of survivor benefit is the age at which the widow or widower claims the survivor benefit. If he or she claims at 60 or 50 if they're disabled, survivor benefit, it's discounted, 71.5%. Unless it's full retirement age, which is 100%. If you're somewhere between 60 and 70, then it's obviously prorated. If both spouses are receiving benefits and one dies, the other may switch to the higher benefit. Here's Joe and Julie again. Both are over full retirement age and receiving benefits. Joe's $3,600, Julie's $1,800. Joe passes. Julie contacts Social Security. Her benefit stops and she moves up. She gets Joe's benefit of $3,600. Pretty sweet. If Joe had waited to file and collect at age 70, well, he gets $4,464, not the $3,600. And when he passes, well, Julie gets that. She contacts Social Security and says, my husband passed. I want to switch from my benefit to his. Give me $4,464. And they do. So you can see the survivor planning, very important decisions you make now influence your surviving spouse's standard of living later. There are some rules around that. You have to have been married at least 9 months. Survivor has to be at least 60 or 50 if disabled. If you remarry, the benefits stop, and divorced spouse benefits are available if the marriage lasted at least 10 years. So let's talk about divorced spouse benefits. You can receive, a divorced spouse can receive Social Security based on your ex's work record. Providing the marriage was at least 10 years, the person receiving benefits is currently unmarried. If the divorce occurred more than 2 years ago, the ex-spouse doesn't need to have filed for their benefit, but they must be at least age 62. Guess it would be helpful if I put that on the slide. Just pause here for a sec. Let's keep going. Just a few more slides, folks. Here's the rules. Let me populate the rules. The rules for divorced spouse benefits. More than one ex-spouse can receive benefits on the same worker's record. This is wild. This blew me away. Let me give you an example. If your ex has married and remarried 3 times, all 3 ex, we'll use wives here as in our example, all 3 ex-wives can claim divorced spouse benefits as long as each marriage lasted 10 years. Very, very generous of Social Security. The benefits paid to one ex don't affect anyone else, including the ex. You don't need to know where your ex is or what they're doing. Just enough identifying information to give Social Security so they can track them down and look up the records. You're going to need to provide documentation showing your dates of marriage and your divorce. If you're receiving these benefits and you remarry, your benefits will stop, but you may be eligible for spousal benefits based on your new spouse's work record, or you can switch to your own. Lots to know here, folks. It can certainly make your head spin. And now you understand why we made this statement at the very beginning of the presentation. We have 4 key insights from today. We all know Social Security is lifetime income. Your monthly benefit will be reduced if you claim early, but as we established, claiming early is not necessarily a mistake. If you're married, you need a strategy to maximize both your benefits. If you're widowed or divorced, you may be eligible to claim benefits that can increase your benefit amount. And so that understanding of the problem, it brings us to this solution. Again, I'm happy to send you these slides if you like. Just shoot me an email, and I'll have my address up in a second. You might do a little math here to see what your monthly income looks like from this list. It's also important to consider Social Security in the context of your other retirement resources, the pension, the IRAs, the TSP, required minimum distributions that start at age 73, your investment portfolio, your plans for working in retirement. All of these should be coordinated to give you the income you need for the rest of your life. Please don't be afraid to ask for help. Retirement planning, it's easy when it's a matter of stashing part of your salary into a TSP or a 401k and an IRA. But when it comes time to convert that nest egg to an income stream, you want to make sure it doesn't run out. Social Security may be the bedrock of your retirement income plan, but it must be coordinated with your other resources to give you stability and security. This not only helps with your Social Security planning, but also your retirement planning. Okay, very important here. The Social Security folks, they're helpful, but they don't make recommendations. It's not their job to do long-range Social Security planning because they don't know. They don't know what's going on with the rest of your personal finances. If you need someone to talk to, we would be glad to help you consider each of these questions individually, to help you come up with your own game plan. Here's my contact information. If you have a question, please shoot me an email. If you'd like to learn more about me and my firm, check us out on our website. You can connect with me on LinkedIn. Slides available upon request. If you're interested in the complimentary meeting, just shoot me an email and we'll get that scheduled. Thanks so much for your time, folks. I really appreciate you being here today. And I hope you'll consider attending in the future.